All right, welcome back to the channel. So today we're going to cover the S&P by looking at the SPY, and then we're going to look into some macroeconomic data over the past week, and then we're going to cover some updates to that Amazon and those AMD trades that we have on. Hopping over to the charts, looking at the SPY, we have this on a monthly chart. What I want to point out here is since we finished October, we have had 3 down months in a row. You can see that's kind of rare over the course of history. There's not really a lot of consecutive 3 months in a row. We have 1, 2, just 1, 2 last year. As ugly as last year was, we didn't have 3. So that's interesting. Nonetheless, thought I'd point it out. Actually, I wonder if we look back at like 2008 time frame. I guess there was quite a few, but still, if we have to go all the way back to 2008, you can see how rare it is. There was some back here. 1, 2, 1, 2. The solid bars are down candles ultimately, so 1, 2, 3, 4. Either way, you get the point. So hopping over to a 1 week, we can see that this week's candle was a giant up move, completely erasing last week's candle. Opened within range of last week, closed well outside of even the tails of last week, and closed even above the open of 2 weeks ago. Really unfortunate for the bears and me at this point, but what are you gonna do? Interestingly enough, on a weekly chart, it looks like we closed right at the 50-day moving average. Yeah, just slightly above it, it looks like on the daily chart. So the yellow line here is going to be the 50-day simple moving average, and these will stay the way I have this plotted here as days specifically. They're not, if you are to change the time frame, a lot of times when you use these moving averages, you have to be careful. It's usually, even if you call them dailies, they'll be session moving averages. But these lines are programmed in to only pull data from daily, so they will stick to whatever time frame you're looking at. We'll hop over to a 15-minute chart and we should be able to see that. Yeah, so you can see we're just slightly above that moving average. So this is that 50-day moving average here, and you can see it's extended by these dotted lines right here, and we're slightly above it. So that confirms what we're seeing on the daily chart. Again, this is the 50. And we've closed right above it. So just to be safe, just wanted to point that out. So if you're trying to recapitulate some of these charts on your own, just be like, well, what's going on? My 200 days at a way different area. Might be dependent on the time frame you're looking at. All right, with that out of the way, just looking at last week's action, I mean, it's pretty wild. Personally, you all know that I have a bearish bias on the market right now, so we'll just get that right out of the way. And one thing I want to mention as far as confirming that views to make myself and all of you more biased is these gaps. I mean, good Lord. Do gaps happen in bullish markets? Not quite as often. I would say really the hallmarks of a bearish market are gaps. And if you just want to kind of anecdotally look at this, check out a lot of the down moves you'll get, big gaps whenever the market is clearly, we can historically look back and say, yeah, this is a downtrend throughout here. You'll see many more gaps in this series of data than you'll see in this series of data going up. So in 2021, we're going up every day. Sure, you get some gaps here, but for the more or less, this is a much tighter channel. You're really opening and closing within ranges of the previous day. There's just a lot less gaps, and this is during 2021 when there's still so much uncertainty around, what the hell was going on. So, take that for what you will. These gaps just don't look healthy. When you see this many days, every day this week, I think there was even a gap between, it looks like the open was here, and the close would have been here. So, that's a gap, and we didn't even overlap any of these wicks right here. So, this was Friday, Thursday, Wednesday, Tuesday, last 4 trading days of the week, ton of gaps. It just doesn't seem healthy. A few more things I want to point out on a daily chart of the SPY before we move forward. So these are some of the areas, some of the trend channels and stuff I'm looking at. So I guess we'll just go left to right. We are currently around 5.5% away from the highs that we made in July. They aren't the all-time highs. Those are still obviously way up here, January of 22. As far as the lows that we made recently, so last Friday when we were trading down here to 409, and it seemed like everyone on CNBC, they might have even rolled out the markets in turmoil banner. I'm not even sure, but it seems like everyone was a little worried that all hell was going to break or loose. From where we closed on Friday to that low, we are off about nearly 6%. So 6% move in a week. Whew. As far as the overall trend channel that we're in, right now I'm looking at this downward trend. You can see it started to form after we made a bottom here, came up to the top, and then sold back off again, made a bottom, and then came up to the top of the trend channel. I know we're outside of these trend channels. I like to think of these as more general guidelines, really drawing trends with a Sharpie instead of precision lines here. So yes, we are out of it right now, but the way I have it drawn, we were out of it here too. So really what I'm looking for is, will this trend channel be respected? Will we continue the downtrend? Or is it going to be completely unvalidated? For me, an unvalidation would be, first off, we're going to need to make a new lower high. So if we have, a high, a lower low, a lower high, a lower low between these two, and this is, again, another lower high, another lower low. If we end up making a higher high than this high, that would be very strong key indication that this channel is invalidated and no longer intact. We are again over the exponential moving averages. We're back over the 200-day, and we are also over the 50 days we just mentioned earlier. So looking at the hourly chart, you can really get a good idea of how this market behaved this week. It was just, market opens, stocks are up every single day of the week, with these huge gaps in between. A lot of this started out right out of the gates on Monday because there was the quarterly refunding announcement, the QRA, which basically says, how the Treasury is going to issue debt. Basically Congress decides how much debt is, how much money the government needs to operate for all these different things we're funding, all these multiple wars, all these entitlement programs. They have to be paid for somehow. So they say, we need this much money. They go to the Treasury, and the Treasury has to come up with a way to fundraise, essentially. So they issue debt. They issue T-bills, bonds, notes, which just means different durations of U.S. Treasuries, ultimately. But the big question is how they're going to issue this. We've had the largest retail inflows to TLT, I've been told, that we've ever had on record. So, what is the TLT? Ultimately, the TLT is a basket of, what they call 20-plus year bonds. So you can imagine, iShares is buying up all kinds of, 30-year paper consistently, and the average duration of this whole basket is around 20 years. So, it's a good way to represent the longer end of the yield curve, longer dated U.S. Treasuries. And, why are there these huge inflows? Well, the theory is, if the government cuts rates, that means somebody is buying the bonds. And, in the past, through quantitative easing, it's been the Federal Reserve. So the Federal Reserve comes in, they buy up all these bonds that are issued. That money ultimately funds the government. So in a way, it's our government is that's what we say is just printing paper, because they are issuing debt on one hand, and then the other hand is paying that debt. And it's really pretty disgusting, and it's amazing that this happens, but this is how we've operated for years. That's why you can look at the Federal Reserve balance sheet, and you can see during 2020 we had to fund the government, and who's going to buy all this money that we have to raise? If we have to raise trillions of dollars, to support programs to keep the government operating, well, someone's got to buy it. If we dump such a huge supply of bonds onto the world, Japan can only sponge up so much. They're the biggest buyer of U.S. Treasuries right now. But if they have to defend their currency because their inflation's getting out of control, they might have to stop buying as much, because that's how they could strengthen their currency. Because ultimately, currency strength is all just relative between the two currencies you're comparing. If our rates go up, our U.S. dollar gets very strong. If Japan is lowering rates, their dollar gets very weak. But the point is it's differentials between interest rates that central banks set in different countries. But getting back to the point of the Federal Reserve, they came in and they were the buyers. They call it the lenders of last resort. Lenders, because they're lending to the U.S. government by buying the debt. So you can see their balance sheet exploded. So this is basically, if you had a portfolio full of bonds, this is how much is on it. So the Federal Reserve stepped in and bought all of this paper, leading to this insanely large balance sheet. And then after, Corona kind of fizzled out, Ukraine war started, and then we realized, oh, this inflation isn't transitory, we got to get it under control. They started quantitative easing. So they started letting these bonds they have on their balance sheet, as they come to maturity, they expire, and then they hold the cash, but they don't reinvest that cash by buying new bonds. So if you do this into perpetuity, those bonds would all expire, they would have cash, that cash goes to the government for funding, and then, their balance sheet would get smaller. So this is quantitative tightening, is what they refer to. So we were doing good until last March, when all of a sudden we had to bail out all the banks. So of course they stepped back in and saved them, bought a shit ton more debt, and we've been on track with quantitative tightening since then. It's really insane. As you can go back and you can, I bet you can spot on this chart, if you didn't have this, x-axis down here where 2008 was, because you see all this craziness of our economy, at least, over the majority of my lifetime, has started from 2008, when they just stepped in and bought all kinds of federal treasuries, corporate treasuries, everything, put it on their balance sheet. And really, we've been in this environment of quantitative easing since then, because ultimately our economy can't exist without these cheap interest rates. I mean, imagine yourself trying to go buy a house without using a mortgage. It just wouldn't happen. Well, that's how these companies operate right now, and it's kind of a shame. I know I'm way off topic, but let's hop back over to the SPY. So ultimately, what seemed to have happened this week is when the quarterly refunding announcement came out, they basically announced that they're going to raise the money that they are tasked to do, but they're going to do it more with short end bills and not the back end, like longer dated maturities. So one way we can visualize this is by looking at the yield curve. So this is going to be a very complicated chart to explain, but ultimately what we're looking at here is three different pairs of yield curves, or three different yield curves. So the white one here is going to be the very short end, and so we're comparing the yield curve between the 3-month and the 10-year. Blue line here is going to be the 2-year, 10-year yield curve, so it's kind of the belly, the middle of the yield curves. And then the later dated yield curve is going to be the 10-year, 30-year, just so each one of these has a point that we can compare, which is the 10-year. So each one of these you can see has a 10-year. So the shortest dated 3-month to the 10-year, kind of intermediate 2-year to 10-year, and then the 10-year relative to the 30-year. The 210 is probably the most famous, most looked at one that everyone quotes on Bloomberg and CNBC. So it is clearly inverging. See, inversion, by the way we're looking at it here, would be 100%. That's this solid line right here. As long as we're over the line, we're inverted the way that it should not be. We have been uninverting, which is typically when the recessions start, for various reasons. But just recently, this week, with the news that they are going to flood the market with shorter dated paper, the yields had spiked on the front end, causing this yield curve to absolutely skyrocket, while the middle and the late end yield curves started to sell off. So ultimately, how does this affect individual bonds? Well, we can pull up a 10-year itself, and we can see over this last trading week, they had just dumped, and as well as the had the 1 year, but not to the same degree as the later end. Thing is especially tech related stocks, anything in the QQQ, the bulk of what's holding up our entire market right now, is priced off the long end. So we can just simply look at TLT and see what's happening. So we were looking at yields earlier. This is the inverse, because it's going to be the price. So you can see if TLT goes up, more than likely the Qs are going up too, or the NASDAQ tech related stuff's going up. So, and a lot of that is just based purely on valuation models of how a lot of these machines trade. So they don't have any judgment. They're like, okay, if the price of long dated treasuries is going up, buy tech. So what do we see in the market this week? Well, popping over to the Qs, you can see, yeah, we absolutely rocketed. A lot of that makes sense. Now, the thing that is very hard for me to rationalize is, why are people buying bonds at all? It's like, I get it from me. The yield's high. I'll buy some of these and hold them to maturity and happily, take the coupon payment right now at being around 5%. But, right now they're not 5%. Why are people continuing to buy them at 4.5 on the 10-year? Well, typically people buy bonds when the uncertainty of the future is bad. So there is this kind of push and pull, which I guess that's what makes a market. Some people see it as a buying opportunity. Some people see it as a selling opportunity. But if people are ultimately buying bonds, that usually isn't a good signal, for the market. It's the same as people buying gold, piling into gold. It's, uncertainty with how the corporations are going to operate, which if corporations do bad, in general, you would expect their stock prices to decline over time. So for whatever reason, bond yields down, bond prices up, stock market up this week. So go figure. Because of that, you also saw VIX get absolutely demolished this week. So 1, 2, 3, 4, 5. You can see, we were at our relative highs around 22. This entire week, every day, absolutely killed VIX. What does that do? Well, when VIX is down, that allows volatility funds, which are, make the backbone of, along with CTAs, for everyone's 401k funds, they absolutely, are told to buy. Fall down, buy stocks. More buying of stocks pushes the market up. And that's about as simple as it gets, right? One thing I want to show here is here's a chart from Spot Gamma. So we'll start to transition over, I guess, into the macro stuff. So starting now. So from some of the macroeconomic stuff I like to look at, this is systematic positioning by a lot of these, algorithms that make up the target dated funds of everyone's 401k. So really the biggest buyers in the room. Tier 1 Alpha puts out great research on volatility trading funds and CTAs, commodity trading advisors, that are basically trend followers. So market's trending up, they buy, market's trending down, they sell. We'll get into that in just a second. But these systematic traders, I believe, for this chart are specifically looking at the volatility funds. So this is kind of why there was that little bit of that confusion last week. So, they were huge sellers last week, forced the market down. But at the same time, CTAs were told to buy in most environments. So it was just like, okay, well, we have buyback windows opening up. We're getting very oversold. Why are we continuing to sell off? Well, there was lots of systematic trading unwind, so it pulled the market down. Unfortunately, this week, I guess there was a little bit of turmoil because the systematic positioning was still short and the market started to rip. So, that's probably not good for everyone's 401ks, at least for, I'm sure they're up this week, but probably not to the degree they would be if you were just holding long SPY, which that's just a slight little jab at the 401k buy and hold non-managed fund that I'll just slide in there. I'm looking for a chart real quick. There's another thing I want to go ahead and just talk about how the CTAs are positioned. So we can see the CTAs basically have levels where they're told to buy or sell. Right now, this is looking at the S&P, obviously, and it looks like from my notes over here that Goldman Sachs puts out on a flat tape, they have 36 billion. They're short 36 billion to buy. I think there's a typo there. There's a negative sign there. It should be positive. So it looks like in a flat tape they're buying 36 billion. In an up tape they're buying 207 billion. And in a down tape they have 50 billion to sell. We're past all three of their levels. They're short term, medium term, and long term. So they are in full buy mode. If we were going to look at how this looks on a kind of a hypothetical positioning chart, we can see here this 2 standard deviation. This would be a giant up move. They have a ton to buy, and then as far as medium tape, flat tape, you can see they're pretty much all up. I guess technically here in a down tape there's a little bit to sell, but you can see it's nothing compared because this line looks basically like upsloping to me, but it's nothing relative to this big 2 standard deviation. The way we're moving, that might happen. I mentioned that because if we were just to hop in and look at a chart of the RSI, we can see that we were getting oversold. This was going into last week. We were talking about, hey, we might get a bounce. Things are looking pretty oversold right here. Yeah, oversold conditions the market can keep on rolling over, but prepare for a bounce. We were prepared for a bounce, not as good as we should have been, but hey, it is what it is. So we got the bounce rather dramatically this week, and you can see we quickly have bounced up over the 50%. On the RSI, of course, if we're going to keep running, we have a lot further to go, which is probably what's going to happen. But that is that. You can see on the NDX, we're more or less the same story here. Looking at some other situations, I'll just show this real quick. This is that fear greed index. We're not even in neutral yet for however they calculate this. One thing that is important to look at is the gamma positioning. We flipped from being, you can see if we were below this line, a higher volatility environment of dealers being short gamma. We're now in positive gamma environment for dealers. So that typically leads to a lack of volatility, and a lack of volatility typically leads to a big up move. So we can see here this was kind of more of a sentiment indicator. I believe this is percentage of stocks that are under their 5-day moving average versus over. So we went from the majority of stocks being below their 5-day moving average to very quickly quite a few over. And I believe this is the highest back since March, which you can imagine. This whole May and June was very bullish. So it makes sense because this was quite the face ripper this week. All right, now we're going to pop over and get into more of the straight up macroeconomic data instead of stuff that's directly related to the market. Macro speaking, the financial conditions have loosened substantially this week from the market ripping, and basically just the whole world knowing, okay, the government's going to flood the whole world with a lot more T-bill issuance. The popping over to some of the jobs numbers, one of the charts I find the most interesting this year is every single month we have gotten revisions to the number. So this, here we go. Now you can see the axis. So the original number is in blue. The revision is in green, and then in many of these cases, we've even had re-revisions to the previous data. So it's just, you cannot trust this data coming out. It is constantly being revised down. You would think the administration every single month they want to give a good number. They want to say, hey, jobs are strong, the economy is strong. So they put out a big number, and then when the next month's data comes out, they revise down the previous month. Maybe it's not as sinister as that, but at face value, that's sure how it looks. So you can see there was a decline, even with their this month's data, which will more than likely be revised down in the future. We were expected to be 170 to 185,000, I believe was consensus on Wall Street. It was 150, so it was below the expected number. So that you would think, oh wow, jobs are down. Why? And it's below expectation. That says we are in a weak economy. A weak economy should lead to lower asset prices because, hey, people are getting laid off. They're not going to have money to contribute to their 401ks. They're not going to have all the discretionary money to buy everything they need. We're certainly seeing that in the Apple's earnings this week, which was, not as great as I think they would have wanted. Just because people don't have all this, if they're not flush with cash, they can't as easily go buy the new iPhones. And so, weaker economy, stock prices should go down. However, we're in this backwards world right now where bad news is fantastic news. And the whole thought is well, if the economy is that bad, the Fed's going to step in, lower rates, buy up all that debt. Rates are going to be zero. You're going to be able to finance anything. Companies are going to have all this money, and stocks go to the moon. The problem is what that I personally can't reconcile with right now, which is pretty much how it seems the whole world is divided right now, is that playbook really good or bad for stocks? And I say it still has to be bad because I don't think the Fed is going to be as easily convinced to drop rates to zero again when that is what got us in this inflation mess of 2020. So yeah, you did it in 2000. It worked great. Yeah, you did it in 2008. It worked great. But we were able to offset all the inflation we would have had because China was coming online as a huge, manufacturing superpower that was able to absorb all of our inflation. So now we know that we tried it in 2020 and we got this inflation. So we're kind of tapped out. We can't offshore the inflation that we're creating from this money printing. So if the Fed thinks that way, then you would imagine they're going to be hesitant to ever lower rates. If they don't lower rates, eventually these will cause the market to have some significant issues. A lot more layoffs and crappier earnings. We're seeing that in CapEx spending. CapEx spending has been on a huge decline this whole year. I'll pull a chart up for that real quick. So here's a chart of CapEx spending. You can see, CapEx spending is essentially what companies are going to spend on, capital expenditure. And if companies were really growing and they knew they were going to be able to have all this cheap money, to grow companies, they'd be spending money like crazy on CapEx. And you can see since November of 21 or January 22, companies have been reticent to invest more in CapEx. So they're reducing their overhead. They're trying to basically tighten the belt, save cash. That doesn't really seem like a very good growth expansionary environment to me. So that is that. So looking back at some of the more of the jobs data that we were previously talking about before I got sidetracked with the CapEx stuff, you can see we have two different types of surveys here. We have the establishment survey, which was at the 150,000 jobs that were created this last month that we were just talking about. But the household survey is a different kind of survey where they actually call individuals and they ask them about unemployment and unemployment, and I believe also how confident they are that they could be able to find a job if they were laid off in the next month or something. And I personally think this data is more important because if somebody calls you on the phone and you have to tell them like how confident you are or if you just lost a job, that's very real-time data and it's less manipulated. So it shows a very large move to the downside. It looks to me, by the way this chart is plotted, that it is the biggest down move as far as, people self-reporting unemployment back to the pandemic when all the layoffs were happening. So that, hey, doesn't seem bullish for the economy, but I guess if the government's going to step in and fund everything, it is. But I just personally hope and don't see that happening as easily as people think. Here's another survey that we can say is the multiple job holders. Obviously, it's going up. You got to ask yourself, why do people want multiple jobs? Well, everybody wants more money, but not everybody goes and gets multiple jobs because there is only so many hours in the day, and it's very hard to work multiple jobs. And even focus on one job these days with everything your corporations are asking out of people to do for such low wages. And if people are getting multiple jobs because they have to, ultimately. They need more of that discretionary spending. They just need more spending for groceries, even as much as inflation has caused prices to go up and stay here. Even if inflation goes to zero and prices stay here, people are going to be strapped for cash. Especially if inflation goes to zero, that means there's a ton of layoffs. If there's all these layoffs, people just aren't going to have money because they're not going to have jobs. And then you would think there's deflation because prices are coming down. But at that point, we'll worry about that another day, because at that point the market will be down and I'll be very happy. But moving forward, the one other chart to look at as far as unemployment goes, or employment goes, is of those 150,000 jobs that were created, a huge percentage of them are government jobs. You got to wonder, is the government stepping in and actually employing more jobs month over month, even if they're just fake jobs on paper, just to pad the stats? Potentially. I really would like to be able to find out how to look at the data on what the average job creation by the government is over time, but I do not know where to find that data. If anyone knows where to find that data, let me know. Throw it in the comments. And while you're at it, like and subscribe. Looking at the household and establishment survey, I should have showed this chart earlier. You can see the establishment survey is showing just more job creation as normal, and then the at a slower pace, obviously, because what we're looking at on the last one was the month-over-month change. But as a total, as far as jobs go, you can see it is increasing, while the household survey in red is at least here decreasing. Unemployment rate has ticked up to 3.9%. Generally speaking, we never have a run in 50 basis points increase of unemployment within a 6-month. 1, 2, 3, 4, 5, 6. Oh my God, we're right there within a 6-month window. Oh, it says it right here. Okay, this is what I was quoting. I didn't realize someone put it right on the chart. Yeah, so by this Sam's rule, we've never had this situation happen, which I guess just happened by Friday's data, without having a recession. So, good luck with that, bulls. I'm really salty this week, you can tell. I'm sorry. I'll try to rein in the biasness of my positions. It's okay. Took off a lot of short puts in the SPY this week, so net this week to last week, doing just fine. But it sure would have been nice if all those butterflies under the market I had paid off, but that's for another day. Average hourly earnings have decreased. This is, kind of what the average earnings per hour is. If the consumer is going to continue to get weaker, if their earnings are going down and prices are going up, that's just simple math. Looking over here, this is a little bit different. We're going to be looking at money market funds. There's continued inflows to money market funds. That makes sense. Yields around 5%. I talked to about 3 people this week that said, oh, hey, guess what? I opened up a CD for the first time. I'm like, yeah, good for you. Cool. Lock in that 5% for 18 months or whatever. That's money on the table if you have cash lying around. So continued inflows to money market funds. This is seasonally adjusted data, which is typically the more rosy your picture of data, and you can see that commercial bank liabilities, so what people are putting in banks, what they're putting in their checking and savings accounts, are continuing to, well, they're not increasing over this run. So this is, if you think back to March when the banks started to collapse, that's when really people were getting scared of money. They started taking them out of banks, putting them in money market funds, putting them in brokerage accounts. But we've pretty much been flat, chopping around this area. So there's that. While speaking of the seasonally adjusted data, you can see here the blue is the weekly change in that same data series of bank deposits. That'll be the seasonally adjusted. The non-seasonally adjusted, you can see, is actually divergent, which happens quite frequently. There's a lot of seasonal adjustments that are done, in my very cynical view, I think, to kind of make the data look better than it should. But you can see this week it was outflows, while the seasonally adjusted data says it was inflows. Now we'll pop over and talk about some of the trades we had on. We had to do some adjustments this week, that's for sure. So as you can see from this week, this would be Friday, Thursday, Wednesday, Tuesday, Monday, we have had a violent move along with the market in AMD, as well with Amazon. We'll look at that one next, but starting with AMD, we had to defend this position. We definitely had to do a lot more adjustments to the trade, and we'll go over those right now. So for the AMD trade, we had to make some adjustments this week. On the 1st of November, we ended up having to do a delta adjustment, roll up the puts. To do that, we were able to collect $1.49. And then since this stock kept on rallying, we had to go ahead and do another delta adjustment, rolling the puts up again. Now we're short the 105 put. And, you know, I have here, it's an iron butterfly. It's actually not yet, but it's pretty much there because we are currently in December short the 110 call. So, but we're probably gonna have to roll these puts up one more time where we're short the 110 and collect another credit, turning this trade into an iron butterfly. I'll show what that looks like in a minute. But that will be where the put and the call that we're both short are on the same strike. Anyways, this adjustment, we're able to collect another $1.98. Our total collected credit for this entire trade is $7.88. Okay, so for the Amazon trade, you can see more or less the same story. Huge gap up. Actually, I believe this is Monday, Friday, Thursday, Wednesday, Tuesday, Monday. Yep, so Monday, again, gap up either way. And they continue to rip throughout the week, so you know we definitely had to do some delta adjustments. Adjustments we had to make since the last video. So on the 30th, which I'm not sure if we covered on the last video or not, we rolled the puts up, rolled the calls up, or down, it looks like, and we collected a credit. $1.73 for each one, $1.47. But then ultimately we needed to roll these puts up like crazy, collected another 77 cents, and then ultimately with selling the 135, collecting $1.55. In total, we've collected $8.91 on this trade. So all right, well that is it for this video. So thanks for joining me today on this trade update for Amazon and AMD.